Hello and welcome to this special YouTube edition on Mutual Fund Corner. I'm Sonal Bhutra and today we are going to be discussing all about international investing via mutual funds. At this point in time when we are talking about some sort of global recession and demand concerns, is it the right time to go about it and how can you take an exposure and what are the risks associated with this scheme as well? We have our expert joining us today, Prableen Bajpai, the founder of FinFix Research and Analytics Private Limited. Prableen, always a pleasure speaking with you. Thank you so much for joining us today. And that's exactly my first question, right? While things are okay in India, we are talking about a global slowdown, a possibility of recession in the US as well. In that case, do you think it's the right time to tap international investing via mutual funds? What is your take here?
Hi, Sonal. Always a pleasure. So I think I'll begin by quoting the World Economic Outlook by IMF, and which does say that the outlook is uncertain again because we do have the financial sector turmoil happening in the US. Inflation remains a concern. There is the ongoing effects of Russia's invasion on Ukraine. And of course, I think some still the after effects of COVID, we are still not totally out of it. So all of these together, I think, have been painting a slightly gloomy picture with, I think, two keywords: inflation, economic slowdown, or recession. Coming to the highlight, and the recession and inflation have actually been, hogging, I think, all the attention, whether it is your newspapers or broader economic reports. Now, coming to recession, especially in the US. So, Sonal, if we just look at what is recession, going by the definition, it is basically a phase in the economic cycle which depicts low or very slow sort of economic activity. And while we all know that there is no official definition of recession, but consensus says that 2 quarters of decline in the real GDP states that the economy or the country is facing recession. And US has actually been through that in the past, which was its shortest recession out of the 35 recessions that it's seen since 1858. The shortest was in Feb of 2022 till about April of 2020. Now, having said that, the IMF reports also states that in 23 there will be an expansion of about 1.6% in US GDP, and by about 1.1% in 2024. So yes, definitely, a lot of macroeconomic indicators do suggest that recession is probably something which cannot be avoided in the US, and many are of also the view that it is not just the Federal Reserve's action, but actually a recession which can bring inflation under control. So it's a very tricky, complex situation, I think, which is evolving in the US. But now, how do we see that with investing, or how do we, join it with how an investor should look at the US markets? So I'd like to give the example of China here, Sonal, that if we look at, let's say, 2007, the Chinese markets, the Shanghai index was at about 5,200 levels. Today, it is at 3,200 levels. So in all these years, Chinese economy has expanded by 6 to 7 years, but the markets have not, reflected or shown that sort of the robustness which is there in the economy. So I think in the US again, the recession, the whole thing about economic slowdown has probably been priced in. We did see a massive fall in the US markets last year. So I feel for investors who are looking at a long-term story, it does make sense to still go and invest in the US and not look at what may happen in the coming quarter or next 2 quarters.
That is an interesting take, and thank you for quoting that with examples as well, because what you spoke about China also says how there is a disconnect with economy and markets as well. In that case, the next question really is about these recent budget amendments, because increasing tax collected on source from 5% to 20%, that's a big hike, right? Do you think it will deter investors from going ahead and investing in international markets? Because that has been the word on street. What is your take here?
So I think that's that will be a dampener. Be it mutual funds, be it your direct investing abroad, because now it will be taxed at slab. So a bit of sort of benefit which investing abroad was getting, they are not going to get that. First is that what happened in the budget. The tax collected at source now that has also gone up. And when I speak to my clients, there is no change in people's plan of whether they're going to send their kids abroad for studies or not. Investing, I feel directly under LRS has still not taken it's not taken off that much. So fine, a couple of people would be, of course, there is a small segment who are investing directly abroad through a lot of these apps and platforms which are available, and they may be a bit of a disincentive there. But whatever conversations I've had, I think people understand that it is only a collection, and eventually, it does come back. Let's say if your tax liabilities are not that high, or it would be set off against whatever your liabilities are. So I don't think that this would be much of a dampener. But I think the tax part, as how your gains are taxed, I think, yeah, that can be a bit of a concern and a disincentive. Overall, what we see that the government is looking to disincentivize people investing abroad, because when we are investing abroad in equities, it is involving risk, and there is no special exemption which is given to investors there.
Oh, okay. Point taken. And of course, money is going out of the country, not getting invested in Indian markets, right? So maybe tracking the funds that are flowing through outside of India is something that the government wanted to achieve via that. That's about general international funds. One category which was recently announced back in Feb was Bandhan Mutual Fund announcing India's first international debt fund. It has been interesting, but tell me, what is your take on this one? What are some of the key advantages, some of the key risks? Because debt category as a whole does not see enough penetration in India itself. Particularly for this product, what's your take?
So, Sonal, this one, I think it came at the right time in March, and probably people who invested, I think, did make the right choice, because now the tax incentive is not there. So I think that actually makes a decent amount of difference in debt funds, because the returns are as it is not in double digits. So the product is basically tracking by Bandhan the treasury bills, the moment in, like we have the T-bills by RBI. It's gonna invest in absolutely sovereign products abroad with a 0 to 1 year maturity. So I feel that this is particularly suitable for those, number one, who understand the bond market movement, especially in the US, are looking to just hedge, against the rupee dollar movement, and keep their money in something where the volatility may be lesser, especially given the timing that the bond yields have gone up significantly in the past 1.5 years because of the Federal Reserve's, all these consecutive rate hikes that it has been making. So from that standpoint, of course, 5% plus in the US Treasury is or sounds good, but then you do undertake the risk of the rupee dollar movement as well. We don't know whether rupee will continue to depreciate, though it has depreciated by more than 65% in the last 10 years. But how it will be in the coming years, it has to say. And again, all of this now will be taxed at slab. So I think the incentive which was there is lesser, but I think it's still fine, suitable for savvy investors who understand these broader dynamics, and then they can probably choose this product, but definitely not for everyone, Sonal. I think because too many complexities in how this is going to work.
Okay, so thank you for that disclaimer as well. Prableen, quickly, if you can tell us, in a portfolio, how much do you think an investor's portfolio or exposure towards international investing be? Any ballpark?
So I think we all randomly, we do give up these percentages, but Sonal, I'll say that, it really depends on the investor's, own risk profile and goals. So I have been interacting with some people who are still very keen to take a sizable chunk abroad, up to 20 to 25%, because they definitely want to send their kids abroad later, or do have certain goals, which require a dollar denominated asset. And they believe in the diversification outside India. So I think it really depends on what is the amount overall size of the portfolio, how much are you looking to invest, and for what is your goal. But definitely investing outside of India can bring in the diversification, and from that point of view, I think lesser than 5% will not make any meaningful change to the overall portfolio. So for regular investors, maybe somewhere between 5 to 10% can be considered, and those with specific goals can definitely invest more. But again, the risks have to be understood. The tax incentive is not there. The rupee dollar movement can work, adverse as well. And of course, there is volatility of the equity markets, which is omnipresent, be it stock markets in India or abroad.
Oh, absolutely. We take that point, Prableen. It was such a pleasure speaking with you. Thank you so much for this masterclass, talking about risks, opportunities, and what more can an investor understand in different categories, actually. Thanks a lot for joining us today.
Thanks so much.
Okay, with that, it's a wrap on this special edition of Mutual Fund Corner. Stay tuned for more updates.